our webinar. Today's speaker will be Mr. Clarence Tree from CEO T3B Capital. And the topic for today is a continuation of the long-term fundamentals versus short-term fundamentals. Alright, so a brief introduction of myself. My name is Jack and I'm from CGS-CIMB, the CFD team. Right, so we'll pass it on to Clarence for his webinar. Right, Clarence, are you ready?
Okay, good. I just realized I just unmuted myself. Okay, good evening, everybody. Although this is part 2 of the session, but we will be doing more on case study. Like for example, the past 2 weeks, what happened to the market, and then even up to the current week. Okay, so this is the topic, long-term fundamentals versus short-term fundamentals. Those of you who joined us for today's session, but you did not join us for the previous session, so you may be a bit lost. But if you are not new to the stock market and you are familiar with some of the market fundamentals, then this should not be a big problem for you or not be a big issue for you. Okay, because you find that recently the market has been quite erratic even for Singapore market. For example, Singapore market, SGX market, yesterday was down, today recovered. So what is the fundamental that is driving it? Basically, you find that market now is driven mainly by fundamentals. Okay, fundamentals, not so much by technical anymore. This is the reason why sometimes you can find the STI doesn't seem to, it can be up, it can be down, like last week it was down, STI down 95 points, and yesterday it was down further, and then today rebounded. What is the reason? What is the thing that is driving it? Now you may think that it's not important, because sometimes it is important, because then you will know which sector, which market sector to focus on, and what are the stocks to focus on. Just because STI rebounded today, it doesn't mean that all sectors recovered, right? Because sometimes the fundamental that drive the market recovery does not apply to all sectors, therefore does not apply to all stocks. And this is very frustrating, because it's not easy to pinpoint which sector will recover or which sector will suffer a setback. So this is something that is not easy. It can be very frustrating. For example, in the US stock market, ever since February this year, what happened? You find that the value stock stands to, the value stocks or the cyclical stock stands to outperform the growth stocks, which are mainly the tech stocks. And you find that this afternoon I posted in the Telegram channel. For those of you who are in our Telegram channel, what happened? The 10-year yield suddenly spiked up again. Okay. For whatever reason, it could be because this coming Thursday morning, 2 a.m. Singapore time, FOMC is going to release the minutes of their previous meeting. Okay, their previous meeting was in the month of April. So market would like to scrutinize the details of these minutes to see to have a clearer picture of the direction of the interest rate, the direction of the tapering of the QE, and how does the FOMC view the inflation. Of course, you'll find that later on I will share with you that most of the FOMC members are in favor of delaying the rate hike, and not every one of them are committed to say that the inflation is transitory. That means it's only temporary. I say transitory means the inflation that is above 2%, which is the Federal Reserve target, is going to be transitory. Okay, not all. You must understand that the Federal Reserve monetary policy is not determined by Jerome Powell alone. Okay, it's determined by FOMC. FOMC stands for Federal Open Market FOMC, Open Market Committee. Okay, and they go by voting. Now, not all members of the FOMC are voting members. Majority are voting members. That means they can vote, whether in favor of certain monetary policy. So this is something you need to know. Okay, so basically long-term fundamentals and short-term fundamentals, and we will
recording in progress.
Okay, we will briefly go through what we have covered last fortnight ago. Okay, basically, I will cover very fast so that we can spend more time doing case study. Okay, so whether you are investor or a trader, and you need to know, because a lot of people do not know whether are they a trader or an investor. And sometimes we find that you only know whether you are a trader or investor after you have gone into the market. Because once you have gone into the market, your position is stuck there. Then you become an investor. Actually, you went in just to be a trader, but because you refuse to cut loss and you are waiting for your position to return back to your favor, so you end up as an investor, and this is a very common mistake. For me, I rather cut loss. Okay, unless I know right from beginning, I go in as an investor. Okay, I go in as an investor. So for those of you who are in our value investing channel, you will know that what are the stocks that I have positioned, and I am an investor. Right from day one when I enter, I know I'm an investor. Okay, I'm not an investor by accident. Okay, please do not ask me about this value investing channel, because if you ask me, that means you do not qualify. Okay, it is only for those people who qualified to be. That means they have taken a course. Okay, a free course from me. Then they are inside the value investing channel. Okay, and the cost is only for our paid subscriber. So whether you are a trader or investor, you find that these days fundamentals can impact your position. Okay, now for example, let me give you an example. Let's say for example, just a case study. A very bad, let's say recently there was retail sales in China. Okay, retail sales came up in China yesterday, and it was bad. It missed the forecast. Okay, and retail sales to miss a forecast is quite bad, because you find that in China, okay, they have already restructured their economy. They no longer depend so much on manufacturing. Instead, they depend more on service, which means that now, unlike 5 years ago, today you find that China economy is basically service oriented, consumption oriented, not so much investment oriented, not so much manufacturing oriented. Which means the growth of the China economy is no longer driven mainly by manufacturing, neither is it driven mainly by investment, but it is driven mainly by what? Consumption and service. Okay, so for retail sales to be bad means miss the forecast is not good, right? It's not a good thing, but it's good for the market. This is the reason why yesterday China market rebounded quite strongly. Why is it good for China market? Because with a weak retail sales, that means what? The market believes that the People's Bank of China, that means the central bank, will be reluctant to increase interest rate or to reduce liquidity in the market. So like what I always tell you guys, those of you who are in the Telegram channel, a bad news for the economy is actually a good news for the market. Okay, a good news for the market. This is the reason why you find that China market recovered, and today China stock market continue to recover, but marginally. Okay, not as much as yesterday. But again, sometimes you find that certain fundamentals may not apply across the board. Okay, certain fundamentals may not apply across the board. For example, if the resurgence of COVID-19 suddenly become very serious, okay, you find that suddenly the Ministry of Health announced circuit breaker. Okay, so it's circuit breaker, another lockdown. Which stocks will benefit and which stocks will suffer? Right. So the fundamental is what? Resurgence of COVID-19. You will find that certain stock will definitely benefit and certain stock will definitely suffer. So you find that on the day when it was sometime last Friday, if I'm not wrong, suddenly they announced enhanced COVID-19 measurements, or what they call heightened alert. Sheng Siong share started to shoot up close to 11%. So Sheng Siong share actually benefit from this because everybody panicked, buy toilet roll, so forth, isn't it? But others, but you find that F&B, so F&B like Tung Lok or Jumbo, example, okay, Jumbo tend to suffer, okay, tend to suffer, and then other retail shares, I say retail shares means like EC-Tan, all this will tend to suffer, isn't it? So you find that certain fundamentals tend to benefit certain sector, but have a negative impact on other sectors. Okay, so this is something you need to know. And then I need to tell something again. Certain fundamentals may impact certain country, okay, in a positive manner, but impact another country in a negative manner. Okay, why? Okay, example again. For example, let's say for example, this is just an example, not a real thing. It's not a real case study or what. A bad economic data comes up in China. A bad economic data, for example, trade balance and so forth. You find it comes out is bad. What happened? Like I say, a bad economic data is good for the China stock market. So China stock market rally. But because it is a bad economic data, countries like Singapore, Malaysia that do a lot of trades with China, will get impacted negatively. Which means that Singapore share market may be adversely impacted by this fundamental. But this fundamental is actually good for China market, okay? Because it is bad news for the economy, but good news for China market. Why is it that it will impact negatively for Singapore market? Because Singapore, we tend to depend a lot of trade with China. So if China economy slows down, we find that a lot of public listed company or those public listed company that have exposure in China will tend to get negatively impacted. It's the same like listed companies in SGX that have exposure, heavy exposure in India, and we all know that India, the COVID-19 has gone out of control. What happened? These companies will get badly hit, isn't it? So for example, Yoma Strategic Holding, I think we all know that this is a Myanmar company. With a situation in Myanmar, definitely Yoma Strategic Holding will be badly impacted. But it's by the fundamentals or rather it's by the political and economic situation in Myanmar. So it doesn't spill over into other sectors. Okay? So if you are an investor, you find that you should be focused on long-term fundamentals. Okay? So you do not depend on short-term fundamentals. Now, what do we mean by short-term fundamentals? Short-term fundamentals are fundamentals that happen probably it will only last for short term. For example, now we are under the heightened alert, okay, or enhanced COVID measure. We know this is going to be short term, right? It's only going to last until June 14 or something like that. Okay, so this is short term. But what is the long term? Long term fundamental is economic recovery. In Singapore, economic recovery, population may get fully vaccinated. Okay, now with the I believe one of the reasons why the Singapore market recovered today is because there was already Ministry of Health today announced officially, although they did preempt the public regarding the vaccination, right? That from May 19 or something like that, everyone will have one jab of vaccine first. Okay, the second jab will be 6 weeks later instead of 3 weeks later. Okay, for me, I already took my 2 jabs. So their priority is basically to get the entire population, those who qualify, those who are suitable to have at least 1 jab, take 1 jab first. So this is good news. This is good news because it will help to slow down the infection rate of COVID-19 in Singapore. Okay, so this could be one of the reasons why market recovered today. Of course, another reason why market recovered today is because Taiwan recovered, right? So we find that these are actually short-term fundamentals. Okay, Taiwan market also recovered, and we know. And then on top of that, you find that in Europe, UK is already starting to loosen their COVID restrictions. Okay, starting to loosen their COVID restrictions. So these are good news. Okay, despite the fact that Malaysia, India, even Indonesia, Japan, the COVID situation is still very bad. Now, one of the reasons you must understand, market is always hungry for good news. Okay. Now, we all know that the situation currently is very bad, right? Because of the COVID. So any good news is offers a light at the end of the tunnel. Okay. Any good news tends to offer the light at the end of the tunnel. That means the market will absorb the good news. Okay, they will tend to overlook or discount all the negative factors like Malaysia, Indonesia, even Philippines or even Thailand. The COVID is actually very bad. Okay, so if you are investor focused on you do not focus on all these small little things. You focus on what economic recovery, and you can see that even SIA rebounded. Actually, for me. I did tell those people in the value investing channel, I said that maybe initially I said maybe I will look to invest in SIA around 460. But then as the situation become very bad, I start to lower my target to 420, 430 or even below $4. But then you find that today suddenly, in fact yesterday already started to rebound. So I'm not. In fact, the day when they announced, I think it was yesterday, or was it today? I can't remember. The Singapore-Hong Kong travel bubble burst. That's the day where SIA rebounded. Anyway, it's already discounted. Everybody expect it to be burst. Okay, so basically this is buy on rumor. It's not a buy on rumor. It's basically a sell on rumor, buy on news. I don't even know what is that. So, but anyway, that's one thing we need to know, that fundamentals is something that's not easy to understand. Okay, you need to follow every day on the market. This is the reason why in our TT Global mobile app. Okay, for those of you who are in our Telegram channel, I think most of you, more than 50% or even 70% have already downloaded this mobile app. Okay, so please read the market update every day. Okay. Now, you may be only interested in Malaysia market. You may only be interested in Singapore market, but it is always good to read all the markets, including the Hong Kong, China market news, as well as the US market. Why? Because nowadays you find that due to globalization, what happened in US market can always impact Hong Kong market, can also impact Malaysia market, can also impact Singapore market. Okay, this is fundamentals. So it's always good to keep yourself in touch as well as up to date regarding market fundamentals. Now, I'm not saying that we ignore technical. I'm also a technical person. Okay, I look at chart patterns, price action, candlestick patterns, and so forth. So if you are a trader, you tend to seize opportunity to profit from any favorable short-term fundamentals or any adverse short-term fundamentals. So for trader, definitely you tend to, so short-term maybe, some people will on Friday when they heard the news about the, phase 2, reverting back to phase 2, they quickly go and long Sheng Siong. Now, do you think they long Sheng Siong for long term? No. Definitely they don't long Sheng Siong for long term. In fact, today Sheng Siong I think came back down. But not much, just come down a little bit due to profit taking. So those people who long on Friday based on the news that Singapore has reverted back to phase 2, this is short-term fundamental. Of course, although this phase 2 is supposed to due to end in June 14 or something like that, the government can always extend. But I'm sure the government is not going to extend for very long, right? The most they extend for another 1 month. Then everybody complain. Okay. Of course, with this lockdown, or rather with this phase 2, you find that some people will they take advantage of these short-term fundamentals. They will long Sheng Siong, short Comfort Delgro, short SBS Transit. Isn't it? So this is one way of, but please understand, when you do this, you are doing this as a trader. Okay, you have no plan to stay in the market for long. Okay, please understand this. So it can be adverse or it can be favorable. Favorable, you long Sheng Siong, right? So and this fundamental, this short-term fundamental is adverse to what? Comfort Delgro, SBS Transit. So what you do is short SBS Transit, Comfort Delgro. If SMRT is still around, I'm sure you will also short SMRT. So question, how short is short-term and how long is long-term fundamentals, right? Now, this is not suitable for us to determine how short is the short-term fundamentals, but all we need to know is to recognize it. Okay? So it's not a matter of how short is short. For example, Singapore reverting back to phase 2 is so obvious it's a short term, right? Because it's not moving. Long term means what? More than a year. Okay? Economic recovery, definitely more than a year, right? Because beyond 1 year from now, Singapore will still continue to experience this economic recovery. Now, if you have been reading the daily market update from my TT Global mobile app under the US market section, you will know that FOMC has been saying the economic recovery even for the US is going to be a bumpy one. It's not going to be smooth. Okay, because the number of jobs to recover from as at the last non-farm payroll is about 8 over million jobs, if I'm not wrong. Okay, I can't recall the number. I think it's either 8 over million or I can't remember. Let's assume it's 8 over million. And they are saying that it's not easy to recover this 8 over million number of jobs for the job market. Okay, so because it's easy to lose job, okay, due to the last year February March pandemic, it's easy to lose job, but it's not easy to create jobs and to recover these jobs for the job market. So this recovering jobs for the job market is basically considered a longer term, because it may take more than a year for US to regain back the job and unemployment rate back to the pre-pandemic level. Okay, so anything that takes more than 1 year to happen is considered long term. Okay, but again, sometimes short-term fundamentals can turn out to be long term if the issue continue to persist. So we do not know. But you know that we have this daily market update. So as long as you continue to update yourself, read the daily market update of all the different markets, you find that you will always be up to date regarding what is happening. Okay, so you shouldn't, but like I say, it's always good to read all the market. It doesn't matter whether you trade US market or not, because US market fundamentals sometimes, whether short term or long term, do spill over. For example, if tonight the 10-year yield continue to remain high, you find the tech stock is going to have a pullback again. Okay, going to have a steep correction down again. This is definitely going to have an implication for tomorrow SGX market, isn't it? You find that today you find UMS, Franken, even Venture, if I'm not wrong, recovered. If tonight the tech stocks drop because the 10-year yield suddenly spike up, don't you find that tomorrow SGX tech stock, Innotech or whatever, AEM, all this may get hit, isn't it? This is the reason why. Because of globalization, you find that we cannot afford to ignore fundamentals even from other markets. Please bear this in mind. Now, I hope you guys know that in the US now, they are having some form of confusion regarding whether to wear mask or not to wear mask, because according to the CDC, I can't remember what you call it, Communicable Disease Center, they say that no longer need to wear mask as long as you already received your 2 jabs of vaccination, and provided you are surrounded mainly by people who already have the vaccine. Now, how do I know? How do I know the people around me already have the vaccine? Nobody know, right? Because they do not have people to monitor. They do not have the safe distancing ambassador. You find the latest news is Walmart already telling their staff and customer that you do not need to wear mask in our department store as long as you have the jab. But how do I know? That's the problem. So now there's a lot of confusion. Some people want to play safe, they will continue to wear masks. Because you have the jab doesn't mean you can't spread. It only means that the probability of you spreading the virus is lower, right? Now we all know that the most recent thing from the Ministry of Health is what? Even you have 2 jabs doesn't mean you cannot contract the virus. Okay. So examples of long-term fundamentals, okay, and this is not exhaustive. Okay, global economic recovery. US definitely is recovering. Okay, US economy definitely is recovering. Singapore economy definitely is recovering. You find that there are analysts, there are economists who actually say that even with this heightened alert, back to phase 2, minimal impact on Singapore economic recovery. Okay, this was what, according to the economists, I think it was published in Business Times. They said that despite the fact that Singapore undergo 4 months of reverting back to phase 2, economic recovery will still be a healthy one. Okay, but I'm not sure about the retail lah. Okay, today you find that if you read the news, online news, you find that retail mall definitely is very quiet. Okay, because if you don't allow people to dine in, who's going to the mall, right? And what's the purpose? What's the use of socializing with two person only? People like to socialize over coffee, right? Dine in and so forth. And, so it's not just the F&B get impacted. Even the retail side also get impacted. Okay, so country's GDP economic data. So the latest Singapore data was the NODX, right? The non-oil domestic export. You find that it dropped. Okay, for the month of April, it dropped. Taking March as a reference, because March there was an increase, and usually March there's an increase because to clear the backlog for February, because February there was a Chinese New Year. Okay, So basically, good economic data is always good fundamental for Singapore, especially for Singapore. You must understand different stock market are the fundamental driver or the market driver, the fundamental market driver are different. Singapore stock market is mainly driven by what? Driven by good economic growth and good earnings, isn't it? It's unlike US. US is driven by liquidity, that's all. Okay? Liquidity and earnings. And even earnings is only temporary. Let's say this quarter earnings is bad. Market, the particular share may drop, but later on recover very fast and start to move up again. Why? Driven by liquidity. Okay? Driven by liquidity. But in Singapore, it's not driven by liquidity. Okay? The MAS, SGX doesn't drive the liquidity into the market, unlike in the US. Okay? In China, it's based on interest rate. Okay? As long as the interest rate remain reasonably low, you find that the market can move. So you find that every market has its own driver. Driver means the factor that drives the market up or down. In Japan, you find that it's also QE. Japan, besides negative interest rate, they have their own QE, and the QE has lasted for many years. Even in the EU, European Union, is also driven by negative interest rate by their own QE. Same for United Kingdom. Okay, you must understand that different countries they use the term QE differently. In Europe, they use it as asset repurchase. Okay, so every time when you read something from the Europe side, when they talk about asset repurchase, it's basically quantitative. Industrial sector prospect. Okay, so for example, we all know with this phase 2, which are the sectors that get it negatively? Of course, we all know will be the what? Retail, right? And F&B. So, and what are the sectors that will get it positively? So perhaps healthcare. Of course, you find transport will also get hit very badly. Supermarket will do well, right? It's like Sheng Siong, will do well, but not Isetan. Right? Isetan definitely won't do well. Business model, very important. Okay? So we find that certain business model tends to able to survive even through a recession, but certain business model they get hit by COVID easily. Okay, so you need to see the business model. For example, communication and media like Facebook, Google. You find that COVID doesn't have any impact on them, because whether there's COVID or no COVID, people continue to view Facebook, people continue to use Google, okay, and their other products. Okay, quarterly earnings, forward earning guidance, and so forth. So these are long term, okay, tends to be long term. Direction of fiscal policies and monetary policies. For example, the FOMC have been trying to assure the market that they will continue to have the interest rate at near 0% throughout the year, throughout the end of this year. And some of them even say it is very possible even through 2022. That means the earliest time to have a rate hike will be sometime in 2023 or even 2024. So this is what we call direction of monetary policies. Okay. So you can see that even for Singapore side fiscal policy, Heng Swee Keat has already said, right, maybe by end of next year or what, aviation, the job support scheme, for aviation tourism will be reduced maybe to 25%, Basically, F&B, now suddenly they bring it up. And for F&B, the job support scheme, they brought it up to 50%, right? Because of this phase 2, originally was at 10%. So this is what we mean by direction of fiscal policy. But of course, this is only temporary measures. But for monetary policies from US, it's very clear. Okay, no interest rate hike for this year and most probably next year, which means it's going to be beyond 1 year, isn't it? So this is considered a long-term direction for monetary policy. So all this, as long as you can be assured that interest rate will remain low, stock market will go up. But the problem is the market doesn't believe. This is the reason why you find that from time to time the 10-year yield of the Treasury, US Treasury notes, from time to time it will spike up because the market don't believe. The market, it's not that the market don't believe, don't trust the FOMC. The market don't believe that inflation above 2% is going to be temporary. Okay, because honestly speaking, even I myself don't believe. Okay, last Saturday during the tutorial session, okay, during my own Zoom tutorial session, I did tell those people who were present, and I explained to them why it is very likely that the inflation beyond 2% is not going to be a temporary one. Okay. And why, I also explained why Jerome Powell believed that it is temporary. Okay. Why he believed it is temporary, and I explained to you why he is wrong. Okay. But due to time factor, I don't think I want to explain here. So inflation and rate hike expectation, this is actually we can call it short term. Okay, US Treasury yield direction and the yield curve. Remember 2 years ago or 3 years ago, yield curve was a thing that spooked the market. Today you find that what spooked the market is the 10-year Treasury yield that spooked the market. So every time the yield spike up, you find that especially the growth stock or the tech stock start to plunge down. Okay, but 3 years ago, if I'm not wrong, 2018, 2019, it was the yield curve. Wherever the yield curve becomes inverted, what happens? The market start to drop again. So you can see what am I trying to tell you? I'm trying to tell you understanding fundamentals is very important. Despite the fact that Janet Yellen is it Janet Yellen? I can't remember, but somebody, I think Janet Yellen already stepped down that time. Despite the fact that a lot of people assured the market that an inverted yield curve need not necessarily lead to a recession, but the market don't believe. Anytime when the yield curve becomes inverted, what happens? Market tank. Start to have a very steep correction, become extremely volatile. Okay, initial announcement of fiscal policy, these are also short term, because market tend to overreact. Okay, so all this COVID-19 pandemic vaccination rollout. One of the things that continue to give strength to the US market is basically the vaccination rollout. Although not all, I don't think even 50% of the US population are going to accept the vaccine, okay? Because those Republicans, those population under the states which are governed by the Republicans, most probably they are not going to accept the vaccination, okay? So the latest is basically what? Unmask. Once you have 2 jabs of vaccine, you can unmask yourself. This is the latest policy in the US. That's why you find that last Friday, what happened? Market continued to go up. Okay, this was the main driver for the market last Friday. Okay, for US market last Friday. And then you find the latest news is what? You find that US is going to have its first transatlantic flight to Italy. Okay, so you find that US and Europe, they are going to have international flight, because you find that UK already start to reduce the restriction for COVID-19, and the rest of Europe will follow soon. The thing is, if they are not careful, which probably they will not be careful, another wave will come. So, and you see, Singapore is so careful. Some people will say Singapore government is not careful enough. But even no matter how we are more careful, definitely we are more careful than the Americans, we are more careful even than the Europeans, yet we can get it a second wave. What more the Europeans and the Americans. So I'm not surprised they're going to have another wave. Okay, once they have another wave, other market is going to bang again. Okay, this one I will skip. Corporate actions. Okay, for example, dividends. You find dividends, announcement for dividends, definitely market is a short-term fundamentals in it. You know, once the stock price goes ex dividend, you find that this is another short-term fundamental. Okay, ex dividend usually what happens to the share? It will start to drop. You know, profit taking comes in. Geopolitical events. You know, then we have the peace factors. PEEST stands for political, economical, environmental, social, and technological factors. You find that recently there is this Hamas and Israel, right? You know, so there's some conflict there in Israel, and it turns out to be very serious. Okay, and this is actually disrupting the peace effort by Joe Biden. He's trying to re-establish diplomatic relations with Iran. So this may be a problem. And the most recent, if you read the daily market update, which I posted this evening, you'll find that there is a conflict. There is now it's not a vaccine race, but it's a microchip race between China and US. So this may lead to a competition. If it's a healthy one, it's okay, but if it's not a healthy one, then more problem. Okay, for those of you who are new, okay, you are here with us for the very first time, or you may not be here with us for the very first time, but you have not joined our Telegram channel. Okay, just in case you would like to join, now I'm not encouraging people to join, because I know we have a lot of people join, but they stay inactive. So no point for you to join, right? Okay, because I'm soon going to remove those people who are inactive from the Telegram channel very soon. Okay. Now, you do not need to pay me a single cent to be active. Okay, just to let you know, you do not need to pay. You don't need to be my subscriber to be active. Okay, as long as you read our announcement properly. Okay, so in case there are people who want to join our Telegram channel, what you need to do is please WhatsApp me. Okay, my mobile number is there, 96771865. Save my mobile number under my name, Clarence G. Okay, please do it by tonight, 8:30 p.m. After 8:30 p.m., I will not accept anymore. Okay, after 8:30 p.m., I will not accept anymore. So what you need to do is WhatsApp me your full name. Like I said, it must be full name, so that I can differentiate you from another person who may have a very similar name as you. Okay, full name means your Christian name or English name, your surname together with your Chinese name, so that I can differentiate you properly. Okay, please do not join if you treat it as another Telegram channel, because a lot of people join a lot of Telegram channel. Okay, please do not join. Okay, join only if you truly want to learn from us. So additional notes. Okay, now you may think I'm basically fundamentals. No, I'm a very technical person. Okay, I'm also a very technical person. So those people who have attended my tutorial session will know that I'm very technical. But I'm also quite fundamental, because nowadays it's always good to understand what is the thing that is driving the stock market up, or what is the thing that is driving the stock market down. Okay? Now, what is the relationship between fundamentals and technical? Basically, fundamental determine the why. Why the stock goes up? What is the thing that is driving the stock goes up? And when is important? When is the news released? When was the news released? How come the market start to go up at 10 p.m.? Why? When? Why exactly at 10 p.m.? So to understand when the market start to go up at 10 p.m., right? When the market start to go up at 10 p.m., because there's a news. News was released at 10 p.m. So the market start to react and go up. Of course, the market can also react by going down. Isn't it? Now, what does technical explain to us? Technical explain to us how did the price of the particular stock react to the fundamental? How did it react? Did it react by going up, or did it react by going down, or did it react by going sideways? Right? So all this can be seen on the chart, right? So it's technical. But then in the event it goes up, where is it going to? Where? Is it going to $2, or is it going to $3, or is it going to $3.50? Where? The chart may be able to tell us. Right? We can draw support, resistance, all the pivot levels, Fibonacci levels. Right? And what Fibonacci levels will form a strong resistance. Very likely that particular resistance is going to be where the price is targeting. Okay? So you can draw a Fibonacci expansion or projection to project where the price is likely to go. So can you see technical tell us where the price is likely to go and how the price is going. How means the direction. Up, down, sideways. Where means what is the price that it is targeting. What is the price that is going. Okay. So if you can understand both fundamentals and technical, bring them together, you find that you tend to grow better as a trader. Okay, you tend to grow better as a trader. So case studies. Let's talk about last Wednesday. Last Wednesday, we all know that the US stock market tanked. Okay, US stock market tanked. Tank means drop. You find a CBOE VIX. Now, I like to see the CBOE VIX because this actually measure the level of fear and panic in the market. CBOE VIX previously was below 20, and all the while it has been below 20. During the COVID last year in March, it went to the high of 60, if I'm not wrong. Or is it 30? Can't remember. Yes, it spiked up to as high as 60, then it started to drop. The moment it dropped back to below 30, that's where the bull market started. Okay, that's where the bull market started. So, but then since this year, okay, since early this year, VIX has been below 20. Okay, around 18, 16, 17. But last Wednesday, it suddenly jumped to as high as 27.70. Okay, I should remove the percentage. Okay, it should not be a percentage there. So it tells us what there's increasing fear and panic in the market. Usually when VIX jump so high, the market tend to drop. Okay, and the reason for this, okay, is because the consumer price index came up at 4.2%. Okay, sometime at 8:30 p.m. last Wednesday, US CPI was released and it was shown to be 4.2%. And this 4.2% is a comparison with a year ago. And you compare the estimate is 3.6%. Forecasted 3.6%, but it increased by 4.2%. That means it went beyond the forecast. And this is the fastest spike of the CPI since 2008, and this is a very serious thing. Because the Federal Reserve has been targeting inflation at 2%, and since 2008 until last year, inflation was staying. They couldn't hit 2%, but suddenly this year, they can actually hit 2%. When I say 2%, 2% annualized, it's not month by month, it's annualized. Okay, and the fact 2% is not based on CPI, but based on personal consumption expenditure, PCE. Okay, at the same time, you find the 10-year Treasury yield also spiked up. It spiked up from 1.619 to 1.698 within a single day. Now, this is a very huge jump. That's why you find that the market started to tank. On top of that, you find that former Treasury Secretary Lawrence Summers said, "I'm very concerned that the Fed's analytical assessment that inflation is transitory, that means temporary, combined with its policy to move towards not being preemptive with respect to inflation will be to repeat the mistakes of the 1960s and 70s. In other words, if the Federal Reserve delay in any rate hike because they see any inflation as transitory, the end result is a hyperinflation. Now because you see, you will know that in the 70s there was this crude oil crisis, right? I think it was 1973. Okay, there was this crude oil crisis. Oil suddenly spiked up. Inflation, there was a hyperinflation. Okay, and then you find that in the 80s, what was interest rate? In the 80s, I just came out to work. Fixed deposit interest rate was what, 7%, 8%, no? You go to Hong Leong Finance, you put in money, they give you a TV, depends on how much money you put in. They give you a microwave, they give you so many good things. You know, because the fixed D was so good. Not like now it's only less than 1%. During those years, I still remember CPF interest rate was 6.5% when I first came out to work. You know, so during those years, interest rate was high. But I'm going to tell you, if the Feds are not going to increase interest, you see, the Fed doesn't want to increase interest rate. Why? Because their mandate is to ensure full employment. But the problem is, there may come a time they will have to force to increase interest rate because inflation is not going to be transitory. They are just using inflation as a transitory, as an excuse for keeping for keeping interest rate low. Then on Thursday, what happened? On Thursday, suddenly the stock market rallied, despite the fact that the producer price index shot up. Okay, the producer price index shot up and it was inflationary. But the market tend to ignore it. Okay, let's see why. Okay, let's see why the market ignored the producer price index, which was inflationary. You find that during the Asia session, European session, the US stock futures, Dow futures, S&P 500 futures, all came down and suddenly shot up. Why? Okay, you find that CBOE closed on Thursday at 18.81. Okay, after spiking on the previous day to 27.70. So it has gone back down to below 20. Now, learn one thing, check the CBOE fix. If it goes up again to above 20 today, tonight, I tell you, means market is going to be very volatile and likely to come back down again. Okay, watch for the 10-year yield. Okay, so you find that on Thursday, what happened? The 10-year yield subsided. Okay, it subsided from the high of 1.702 to 1.629. That means it fell. Okay. Now the reason why is because there were a lot of reassurance from the federal FOMC officials. Okay, for example, Governor Christopher Waller, what did he say? Rate won't rise until FOMC either see inflation above target for a long time or excessively high inflation. Very vague, isn't it? That means you want to see inflation above 2% for a long time. And then your interest rate going to remain at near 0%, which means that your real interest rate will end up negative. Okay? I've explained this during last Saturday's Zoom session, but I got no time to explain again over here. So you end up having a negative real interest rate, Excuse me. You end up having, and then for a long time, that means what? In the end, gold is going to go up. Because interest rate is not going to go up to hedge against inflation, which they admit is going to be high for a long time, or even excessively high inflation, then they will have a rate hike. But by the time they have excessively high inflation, inflation is going to be hyper or run away. You're going to have a big problem. This is the reason why gold started in recent days or weeks, 2 weeks, something like that, starting to move up. Okay? And then the following day on Friday, the US Centers for Disease Control and Prevention eased the guideline saying that in most settings, fully vaccinated people don't need to wear masks indoors and outdoors. The question is, who's going to check? They never say. Walmart already say if you're fully vaccinated, you don't need to wear masks when you come into our store. But who's going to check? Very dangerous, right? Okay, yesterday. Okay, another case study yesterday. Yesterday, China retail sales came up lower than forecast. I think this case study I mentioned earlier during this session. So, came up lower than the forecast. What happened? China, the market takes it as good news. Lower than forecast, that means what? It's not easy for the China Central Bank, which is the People's Bank of China, to have a rate hike. Because retail sales bad, how to have a rate hike? So China's stock market rose. Now, China retail data is adverse for Singapore market. Okay, this is the reason why yesterday Singapore market fell even more. Okay, after the data came out in the morning. Because that means what? China economy is slowing down, and we know that Singapore depends a lot of trade with China, isn't it? So this is actually bad news for Singapore. Okay. So if you can understand the relationship between market fundamentals, what are the fundamentals that drive the market, you learn to appreciate the stock market better. Okay? You learn to appreciate the stock market better. Okay, just a gentle reminder, please, if you want to join the Telegram channel, WhatsApp me by 8:30. After 8:30 p.m., I will not respond. I will not accept anything. Okay, I think okay, Q&A now. Okay, Q&A session now.
Okay, thank you, Clarence. Right, give you guys some time to type your questions into the Q&A box. Alright, around 5 minutes. Then I can share with you more on our website. Right. Okay, so this is our website, cfd.cgs-cimb.com.sg. Right, so for those of you who have not yet opened an account with us, you can actually open an account with us over here at account opening, and then you can follow our online application. So after you have applied the application online, you can send us an email, right? So you can expedite the application. Okay, so for this website, right, we have actually the latest events over here. So for the next webinar, it's also up for Clarence. It's on 10th of June. Right, and other webinars like Introduction to CFD and Viewpoint platform are also available here, so that you can take a look at it. Right, so for clients who wish to fund the account, click Getting Started, and you can go to the funding details over here. You can fund in different currencies. Right. So we are having this promotion right now starting this month for SGX market for CFD, right? Our commission is 0.07%. So instead of 0.25 previously, now we have slashed the rate to 0.07% for SG market. Yeah. Okay, so yeah, that's about it. And then we can move on to the Q&A. Right, so first question, I think this question is quite early already. So Clarence, can you explain why PPI is higher than expected and it can still bring the value/growth stocks higher?
I think I explained to you all just now, right? Because of the reassurance, remember? Okay, let me show you the slide again. So although the PPI was higher, but the market, you see, the market is very selective. It chooses to ignore the PPI because of what? Can you see? The reassurance from the Fed officials about the transitory nature of inflation. Right, so you have the governor, Christopher Waller. What did he say? He signaled that the rate won't rise until FOMC either see inflation above target for a long time or excessively high inflation. But to me, if that is the case, by the time it's too late to have a rate hike. You know why not? If you want to see inflation above the target of 2% for a long time, I do not know what he means by for a long time, or excessively high inflation. In fact, there was another FOMC governor or Federal Reserve governor. He said he wants to see inflation above 2.5%. Then he will start considering have a rate hike. You must understand, by the time inflation is above 2% and the current interest rate is near 0%, what does that mean? That means your rate hike will be your rate hike will not be a 0.25%, no? Will not be 25 percentage points, no? Your rate hike will be very steep. One time you got to jump by 0.5% rate hike. I tell you, the market cannot take it. The market will collapse. Isn't it? So it's better to have a small rate hike, step by step, than to have a sudden rate hike because you have to increase interest rate to catch up with the inflation. Okay, so this is very dangerous. I'm telling you. Okay, I'm telling you. I'm not a doomsday prophet. Okay, ever since 2016, I have always said the market is bullish. Okay, from 2016 even up to 2020 March, I still say the market is bullish. But this time round, I don't think so anymore. Okay, because it's only a matter of time something is going to happen. Okay, because it's better for FOMC to have a rate hike and to prepare the market that there's going to be a rate hike. But one of the main reason why the market doesn't want to have rate hike, or I would say there are two reasons why the market doesn't want to have, or rather why FOMC doesn't want to have rate hike. Okay, let me rephrase again. Two main reasons why FOMC doesn't want to have rate hike. Number one, they want full employment to be restored. Okay, this is what they say lah. Number two, because too much debt. Okay, during Donald Trump's presidency, he already accumulated a lot of debt. Joe Biden, in his first 6 months or first 5 months, he has already accumulated a lot of debt. He has the infrastructure program, he has the American Rescue Stimulus Pack, and all this is additional multiple trillion dollars worth of package. Is going to increase the debt level. Although he say that some of them will be paid by the increase in corporate tax, increase in capital gain tax, but the majority will be what? By debts. Is debt financing, is not by tax financing. So that's why they are planning to keep the interest rate as low as possible. Okay, because the debt level has suddenly gone up. I believe this is the main reason. Okay, because I can tell you the moment they have a rate hike, if they have a rate hike, small rate hike is insufficient to hedge against inflation. Right? So they need to have a bigger rate hike. But a bigger rate hike, one shot, you have such a huge rate hike, I can tell the market cannot take it. The market will collapse, I tell you. And by then, the Federal Reserve doesn't have any more bullets to save the market. Okay, the Federal Reserve doesn't have any more bullets. Last year, March, at the heart of the pandemic, what happened? The market has a lot of, FOMC has a lot of bullets. They start to have the QE, they start to cut interest rate way back to zero. Now, the interest rate is near 0%. Okay, interest rate is near 0%. QE is unlimited. How much bullet do you think the Federal Reserve have to save the market? Zero. No more bullets. Actually, they have one more bullet, but I don't want to tell you all because I need another half an hour to explain. And I don't think a lot of you are able to understand because, okay, so my answer.
Right. So next question is, with the current volatile market, right, what should be the trading strategy for Singapore and US market?
Oh, you got to do it step by step. Honestly speaking, you got to do it step by step. Okay? Which means that at this point of time, definitely I can tell you, US market is not a time for investing. You can only trade. Why? Look at S&P 500 and Dow Jones, they are all near record high. You want to invest when the index is near record high? To invest when the index is near record high, you are trying to say that the index still have a lot of room for upside. So US market is only good for trading at this point of time. It's not good for investing. Investing, I can tell Singapore market still has room for upside. Okay? Singapore market still has room for upside. So that's why my value investing, for those of you who learn value investing from me, my value investing portfolio is all Singapore market. Okay, our ROI for this year to date ROI is about 15%. Okay, so I only invest in Singapore market. I don't invest in US market, just to let you know.
Okay, so since you mentioned Singapore market, right, is SPH worth consideration now?
Actually, I answered this question during what about tutorial session. Why would I want to invest in SPH? Without media and advertising, it is just another property counter. With interest rate going to rise, with risk of another cooling measure, nothing. It's just if you want to invest, and SPH is still a new boy in the market. I mean, unless you love property, you know what I mean? Unless you believe in SPH as to me, it's without media and advertising, it is just another property market. Property market is very important. You know, the margin for property development now is only 20%, 10 to 20%, because they spend so much money in the en bloc. 10 years ago, do you know what was the margin for the developer? 30 to 40%. This now is 10 to 20%. Why? Because they spend so much money on en bloc. So you ask yourself, do you still want? SPH is nothing, it's doomed to fail. What they did is correct to save the media, because Singapore cannot have a national. Without SPH, Singapore will not have a national newspaper, right? That's why the government also must save SIA, because we need a national airline, we need a national press, newspaper press.
Okay, so what about Singapore REITs prospect this year?
Okay, you cannot ask me like that, because REITs, you got to see individual REITs. Commercial REITs definitely dead. Right? You need to look at industrial REITs. Recently, the data center REITs all dropped, including Ascendas, but I don't know whether have they recovered. Okay, so you cannot ask me REITs generally, because REITs you got to see by itself. Okay, who are in the management? What are the projects? What are the portfolio they have? So you need to go and scrutinize. Share investor, I think they have a REITs symposium, right? I think yesterday and today, I can't remember when is it. You should have gone to see it is online. It is actually an online REITs symposium. You should go and see. I did not go and see because I'm not interested in REITs, honestly speaking. I find you see, the problem with REITs is this: a lot of people invest REITs wrongly. Okay, REITs is not for trading; it's for investing. The problem is a lot of people after investing REITs, they get the distribution. REITs is not dividend, right? It's DPU. You get the DPU, but then when the REITs collapse, right? The REITs fluctuate and then start to have a 10% correction. Your capital loss wipe out all your return, right? Wipe out all your yield. So the best time to invest in the REITs which you think is good is after a market crash. Isn't it? After a market crash, you invest in the REIT, you find that the downside for the REIT is low, so your yield is preserved. Never invest in a REIT because the fella is high.
Okay, so what about Hong Kong market? Can invest or trade in Hong Kong market now, and especially on tech stocks like Alibaba and Tencent?
Okay, tech stock today, Hong Kong. You see, you ask me all this, actually it's no point. I will tell you, my answer to you actually is totally useless. I'll tell you a very standard answer. Tech stock today recovered. But I can tell you, if tonight the 10-year yield shoot up, Nasdaq drop, I tell you, tomorrow you see the Hong Kong tech stock start to drop back. Okay, please understand. And then you find that China side regulating. So if you have been reading my daily market update in my mobile app, you will know China is always regulating all the tech stock, anti-monopoly, the database, security, everything. The moment China says something, all the tech stocks start to come down already. So tech stock to me remain volatile. Okay, remain volatile. So if you are those who can take volatility, go ahead. Okay, if you can take the volatility, because one moment it can be somebody say something right? Recently, Meituan, the chairman, he wrote a poem criticizing the authority. He kinda slam Meituan drop. So to me, tech stock in China is not so much for investing. Okay, because it's too volatile. Like I told you already, the best place to invest is Singapore. Serious, is Singapore. Singapore stock is the best place to. My portfolio I tell you my value investing portfolio. I got all the 3 bank stocks. Okay, AEM, Yangzijiang, and STI ETF. Good enough already. I used to hold SIA. I let go at 5.30. Okay, I bought SIA below $4. Okay.
Okay, so Singapore market. So what are the Singapore dividend paying stock to consider?
Oh, I can't help you. You got to look at it. That's why you got to come for my value investing class. You see, I'm not here to answer all your questions because that's not what I'm supposed to do, because I'm not a licensed advisor. Okay? I'm not a licensed advisor.
Okay, so
because I know there are a lot of people, they come for this Zoom session, they ask, then they go and then they ask, but I can tell you, you will learn nothing. You will learn nothing. Okay, because for me, like last value investing, I also cannot remember. Last week I have a value investing tutorial. It's not just about the dividend, it's about the dividend payout ratio. So how much of the earnings did they pay out? Right? And then the margin of safety. If I were to buy now, how much is the upside? And you want to follow Warren Buffett rule will tell you, if this is the upside, take 50%. Okay, so if the upside is $2, you take 50%, $1. Will you be happy with this $1 upside? Because it's not just about investing in a stock for dividend. You got to make sure the stock also give you capital gain. Because if the stock becomes volatile and start to drop, you find that your capital loss will wipe out all your capital gain. Right? So there are a lot of other factors to consider. So it's not just one. this stock give me very high dividend. It's not about the stock giving high dividend. It's what is the dividend payout ratio? What is the margin of safety? I don't want to. If the stock can give me 8%, let's say if the stock can give me 8% dividend, but its upside is limited. At the moment it plunges 20%, no point. Right? No point. My dividend is nothing. My dividend cannot cover my capital loss. So there are a lot of other factors to look at. Okay, can we have one last question?
One last question. Okay, so
Okay, last two questions.
alright. So what is your short-term view on USD?
Okay, for dollar sink is very unique. Dollar sink seems to be rising. Okay, dollar sink. Okay, dollar sink sometimes it can move on its own. That means it can go independent against the other US dollar against other currencies. Reason is very simple, because the trading range of dollar sink is determined by MES, and MES right now is trying to weaken Singapore dollar. Okay, because trying to support export. So it doesn't want Singapore dollar to be too strong in order to make our export too expensive. Okay, so this one you need to Google to find what is the latest MES trading band for dollar sink. Okay. But of course, if inflation start to come up, okay, if you know every month you find that Ministry of Trade and Industry, if I'm not wrong, will publish the inflation data. If inflation keep on rising, in fact, inflation has been rising for this year, just like US. Singapore is also inflation is rising. If inflation is rising, then MES may want to adopt a neutral stand. That means they don't want to have the Singapore dollar to be too weak. They also don't want it to be too strong. Because if it's too weak, what happens? It will start to import inflation. Okay, so you need to read up. You need to go to the MES website. If I'm not wrong, they do publish the trading band, and they explain why they keep the trading band this manner. You should go and read up. Okay, one last question.
Okay, so last question will be, what is the next big event we need to be alert which could affect the stock market?
Oh, the next big event is always a big surprise. Nobody knows. Right? If everybody knows, because I don't have a crystal ball. I used to have a crystal ball, but it dropped on the floor, cracked into thousands and pieces of glasses. So nobody can tell. If I can tell, I tell you I'll be very rich. You hold on for a while, let me check my chart. Okay, next big thing, I won't know. Okay, next big thing could be inflation truly become high. Okay, then it will affect everybody. Inflation is something that will affect everybody. Okay, let me tell you, crude oil can go further up. Okay, there's still room for crude oil to go up. Why? Because international border has not opened up yet. Isn't it? International border has not fully. The moment international border fully open, I tell you, international flight resume. Even though it may be limited, what happens? Planes are still using fuel, isn't it? They are not using battery. They are not using lithium battery. So demand for crude oil may suddenly shoot up. When crude oil price of crude oil shoot up, don't you find it's inflationary? It's going to be inflation. That's why I say inflation is not going to be transitory. But because of time, I cannot explain. But I already explained to those who attended my tutorial session last Saturday. Okay? It's not going to be transitory. This is the reason why, if you remember 2 weeks ago or 3 weeks ago, Janet Yellen, who is the current Treasury Secretary, she suddenly said there will come a time when interest rate has to go up. But as the Treasury Secretary, she shouldn't say that, no, because this kind of statement should be made by FOMC members, not made by her, even though she was an ex-Fed chair, Federal Reserve chair. It shouldn't be made by her. But why do you think she suddenly made? Because she's overly concerned. This is what I think. She's overly concerned. Why would she suddenly say that there will come a time where inflation will go up and interest rate need to follow? Don't you find that she is concerned? That's why I say the Federal Reserve can be wrong. More than 10 years ago, remember the subprime mortgage crisis that led to the global financial crisis, right? The subprime mortgage crisis, okay, that time Ben Bernanke was the Fed chair. The banks were already warning him, cautioning him, but his reply to them was everything is under control. But he was proven wrong. But eventually, you find the subprime mortgage crisis led to the global financial crisis. And although it's a US subprime mortgage, it affected the entire world. So, I'm saying the Federal Reserve can be wrong. And if they are wrong this time, 2 years later, we may have hyperinflation. Well, you find your property price, you find interest rate goes sky high. I tell you, those people who buy overcommit themselves to properties, I tell you, they will die naked.
Okay, Ken. Alright. I think that was the last question already.
Okay.
Right. Yeah, just to highlight one more time, we are having this promotion, 0.07% for SG market, right? And it's only for 6 months. So it's until this month, until October. So do take note, right? So, okay. Thank you, Clarence. So that's all for
Thank
today.
you, everybody. Have a good evening.
Okay,
Stay
good
safe
night, everyone.
and healthy. Good night.
Stay safe. Right.
Recording stopped.